It's March 2026, and the easy money era is officially a ghost of the past. For years, we lived with 0% interest rates where you could throw a dart at a board and make money, but today, the Fed has held rates at 3.5%. Inflation has finally cooled to 2.1%. But the cost of living is still high, and the market is obsessed with efficiency. Why is this important? Because in 2026, the noise is louder than ever. We have AI energy crunches, new trade tariffs affecting every car and house being built, and a stock market that rewards discipline over hype. If you don't know the difference between a cheap price and a cheap valuation, or if you're ignoring the invisible tax on your cash, you aren't just standing still, you're falling behind. Last time, we talked about the what and the how, but to really master the market in 2026, you need to understand how companies actually pay you and how to tell a corporate giant from a growing startup. Today, we're finishing our investment dictionary with the three missing pieces of the puzzle: dividends, market cap, and the hidden costs that might be draining your wealth without you even knowing it. In part 1, we learned the language. Now, we're looking at the mechanics. How do you actually get a paycheck from your portfolio? How do you tell a corporate giant from a tiny startup? Today, we finish our basic investing dictionary. Welcome to part 2 of the financial dictionary. Dividends and yield, the portfolio paycheck. Let's talk about getting paid while you sleep. A dividend is simply a company sharing its success with you in cash. Think of a dividend as a thank you note from a company, written in cash. When a company is mature and profitable, they often take a portion of those profits and distribute them back to the shareholders. But here is where beginners get confused. They look at the dollar amount, professionals look at the dividend yield, so we must look at the dividend yield. With high-yield savings accounts and bonds paying 3.5%, a stock offering a 2% dividend might look boring. But here's the trick. Dividends can grow while bond payments are fixed. The dividend trap. If you see a company offering a 12% yield today, be careful. Usually, that's not a gift. It's a warning that the stock price has collapsed because investors think the company is in trouble. In this economy, we want dividend aristocrats, companies that have raised their payouts for 25+ years. They are the bedrock of a 2026 portfolio. Market capitalization, don't buy the price. One of the biggest lies in finance is the stock price. A stock at $500 isn't expensive, and a stock at $5 isn't cheap. To know the truth, you need market cap. This tells you the total value of the company. We categorize these into large cap $10 billion plus. The elephants like Microsoft or Apple, they provide the safety you need when tariffs hit the headlines. Mid cap $2 billion, $10 billion, the sweet spot, established but still hungry for growth. Small cap under $2 billion, the mice, fast but fragile. If your portfolio is full of $2 stocks, you aren't an investor. You're a collector of mice in a room full of elephants. In our blueprint, we don't just buy stocks. We strategically allocate across these sizes to balance our safety and our growth. Balance is the only way to survive 2026 volatility. Opportunity cost, the wealth killer. Finally, the term that keeps millionaires awake at night, opportunity cost. This is the profit you lose by making the wrong choice or no choice at all. You have $10,000 in a safe account, earning 0.1%. You feel secure. But 1-year bonds are paying 3.5%. The cost of your safety isn't $0. In an era where inflation is 2.1%, if your money isn't earning at least that, you are paying an invisible tax every single day. Every dollar has a job. If yours are unemployed in a 0% account, you are paying the highest price of all. You now have extra tools to analyze the 2026 market like a pro. You know how to calculate your paycheck via yield, how to measure the size of a company via market cap, and how to avoid the trap of opportunity cost. You are no longer a spectator. You are starting to think like an analyst. In the next video, we leave the dictionary behind and start building. You're ready for the next step? Comment below. What's the biggest opportunity cost you've paid? Let's fix it together. Investing is the most powerful tool for building wealth, but it is a double-edged sword. Every investment carries a risk of loss, and there are no guarantees in the market. The strategies and concepts I share in the Financial Fix Blueprint are based strictly on my personal vision and my own approach to the markets. I am not a financial advisor, and this content is not intended to be, nor should it be taken as, individual financial advice. My goal is to educate and provide you with a framework to think for yourself. Your financial situation is unique, so before making any major moves, always do your own due diligence or consult with a certified professional. We're here to build a blueprint, but remember, you are the one holding the hammer.